Disclaimer.
What do you do when you borrow something valuable and promise to return it by a specific date, but when that deadline approaches, the item has completely vanished from existence? That's the nightmare keeping Wall Street risk managers awake right now, and the clock is ticking louder every single day. On Christmas Eve, silver prices exploded to $72 an ounce in a violent spike that caught almost everyone off guard. Financial media called it holiday volatility. Some analysts blamed thin trading volumes. But here's what they're not telling you. This wasn't random market noise. This was forced liquidation. This was banks, with their backs against the wall, desperately trying to close positions they can no longer afford to hold because of a deadline racing toward them like a freight train. Let me put this in perspective. Imagine you borrowed your neighbor's car in October, promising to return it by mid-January. But now it's late December, and every single car of that make and model has disappeared from the market. Dealerships are empty. Used car lots have nothing. And your neighbor is knocking on your door in 3 weeks expecting their vehicle back. What do? That's exactly the situation JP Morgan Chase finds itself in right now, except instead of a car, they're on the hook for 128.6 million ounces of physical silver. And the person they borrowed it from isn't some understanding neighbor, it's the Industrial and Commercial Bank of China, the largest bank in the world, and they want their metal back in January. According to lease agreements filed in October, JP Morgan entered into what seemed like a routine transaction. The bank leased massive quantities of silver from ICBC, likely to support their short positions on COMEX or supply industrial clients needing physical delivery. Standard Wall Street practice. You borrow the metal, pay a small lease rate, use it for a few months, then return it when the lease expires. Easy money in normal markets. But these aren't normal markets anymore, and that January repayment deadline has transformed from a routine calendar entry into a financial tripwire that could detonate our entire precious metals market. Here's where it gets interesting. Silver lease rates tell us everything we need to know about the panic building beneath the surface. Back in September, if you wanted to lease physical silver for a few months, you'd pay a sleepy 1/4% interest rate. Boring. Predictable. The kind of rate that screams, plenty of metal available, no problems here. Then something changed. By early December, those same lease rates had climbed to 5%. Eyebrow-raising, but not necessarily alarming. But then, in the span of just 2 weeks leading into Christmas, lease rates absolutely exploded to 40% annualized. Let me repeat that. 40% to lease silver for a few months. Think about what that means. Banks are now willing to pay 40% interest just to borrow physical silver for short periods. That's not a market experiencing a little supply squeeze. That's a market where banks are desperately scrambling to find metal they promised to deliver but cannot locate anywhere on planet Earth. The London Bullion Market Association reports lease rates daily. Their data shows this spike isn't some reporting error or temporary aberration. It's real, it's sustained, and it's getting worse. When lease rates multiply by 160 times in a matter of weeks, that's not normal market volatility. That's a full-blown crisis unfolding in slow motion. Now connect those dots to what happened on Christmas Eve. Silver was trading around $65 on December 23rd. Then, overnight, as most of America was hanging stockings and wrapping presents, the price rocketed to $72 in a matter of hours. A 10% move in one of the most heavily traded commodities markets in the world during a holiday when trading volumes should be at their absolute lowest. The mainstream financial press called it a holiday anomaly. But here's what should grab our attention. The spike happened specifically on Christmas Eve, the last trading day before a long holiday weekend when markets would be closed and nobody could react or hedge their positions. That timing isn't coincidental, that's strategic. Risk managers at major banks understand something crucial about holding underwater short positions over holiday weekends, especially when those positions are tied to physical delivery obligations you cannot meet. If you're short silver at $65 and you've promised to deliver physical metal in January that you don't have, every dollar that silver rises represents millions in potential losses. Now imagine markets are about to close for 4 days, and you're sitting on enormous exposure to a market where lease rates just hit 40% and physical metal has effectively vanished. What would you do? You'd close those positions immediately, regardless of the cost, because the alternative represents unlimited risk. The $72 Christmas Eve spike wasn't buyers rushing in. It was short sellers desperately buying to cover positions they could no longer afford to hold for even one more day. According to COMEX trading data, the volume of contracts bought to close short positions during that Christmas Eve session was abnormally high given the holiday calendar. These weren't new buyers entering the market. These were existing shorts capitulating. And when you're forced to buy in a market with no willing sellers, prices go vertical. But here's the part that should terrify every risk manager on Wall Street. That $72 spike was just the tremor before the earthquake. The real pressure point is still ahead of us. JP Morgan's January lease deadline isn't negotiable. It's a hard contractual obligation to deliver 128.6 million ounces of physical silver to ICBC, and every single day that passes without them securing that metal makes the situation exponentially worse. Have you noticed what's been happening to physical silver availability in the past 60 days? The Shanghai Futures Exchange saw its inventories drop by over 1,000 tons in November alone, representing roughly 40% of their total stock. That metal didn't disappear. China's government simply decided it wasn't leaving the country anymore. On November 3rd, Chinese authorities quietly implemented export restrictions on strategic metals, including silver. No dramatic announcements, no global headlines, just a bureaucratic policy change that removed millions of ounces from the pool of available supply that Western banks like JP Morgan count on to meet their obligations. Meanwhile, India placed orders for 2,000 tons of silver in late November. South Korea announced a $76 billion strategic metals purchasing program. These aren't small retail buyers. These are nations securing supply, and they're all competing for metal from the same shrinking pool. The mathematical reality is simple and brutal. JP Morgan owes ICBC 128.6 million ounces in January. Current COMEX registered inventory, the metal actually available for delivery, sits at just 2.9 million ounces according to CME Group's daily warehouse reports. Even if JP Morgan could somehow claim all of it, which they can't because other contract holders have prior claims, they'd still be short by 125.7 million ounces. This isn't a supply squeeze anymore. This is a countdown to default. And the calendar doesn't care about anyone's feelings. January is 2 weeks away, and the metal simply does not exist in the quantities required to satisfy these obligations without prices going substantially higher to pull supply out of hiding. That Christmas Eve spike to $72, that was banks looking at this deadline and realizing they're out of options. That was forced liquidation driven by calendar reality, not market fundamentals. And if you think 72 is dramatic, wait until you see what happens when the January deadline actually arrives and banks have to either deliver metal they don't have or admit they can't meet their contractual obligations to the largest bank in the world. The clock is ticking, the metal is missing, and our financial system is about to discover what happens when promises meet mathematical impossibility. Now, let me show you why this isn't just theoretical risk. The physical silver market is sending signals that seasoned commodity traders recognize as emergency flares. Between December 2nd and December 5th, according to CME Group warehouse reports, COMEX registered silver inventories collapsed by 47.6 million ounces in just 4 trading days. That's not gradual drawdown. That's panic behavior, the kind of withdrawal pattern you see when institutional players believe they need metal in hand rather than paper promises on a screen. Registered silver is the category that's actually available for delivery against futures contracts. It's the real ammunition backing our paper silver market. The fact that 60% of COMEX registered inventory vanished in 4 days means some very sophisticated players made that exact calculation in early December, right before the Venezuela blockade was announced. They were converting paper into metal because they saw something coming. You want proof that physical scarcity is real? Look at Shanghai. The Shanghai Futures Exchange reported inventory levels of just 663 tons as of December 20th. According to data from the Shanghai Gold Exchange, that's the lowest level in 21 months and represents a 40% decline from October. Chinese vaults are being drained at the exact same moment American vaults are being drained. This isn't coincidence. This is global supply chain stress showing up in the one market that can't be papered over with derivatives. But here's the smoking gun. Silver went into backwardation on December 18th at negative 60 cents per ounce. Backwardation means the market is willing to pay more for silver today than for silver 6 months from now. That only happens when there's desperate demand for physical metal right now that normal pricing relationships break down. According to the London Bullion Market Association, sustained backwardation in silver is extremely rare and has historically preceded major price surges. We're seeing negative 60 cents while COMEX and Shanghai inventories are simultaneously cratering. The market is screaming that physical silver is harder to obtain than the paper price suggests. Now, let me take you back in time, because Ghost Week has triggered massive silver moves before. In December 2010, silver closed the year around $29 per ounce during thin holiday trading. When markets reopened in January 2011, flight to safety buying from the European debt crisis combined with thin liquidity created a perfect setup. Silver went parabolic, reaching $50 per ounce by April 2011, nearly doubling in less than 4 months. The key detail everyone forgets about 2010? COMEX vaults were full. Registered silver inventories sat above 100 million ounces, more than double what we have today. The market had plenty of physical metal to deliver against futures contracts, yet silver still doubled because thin January liquidity met unexpected buying pressure. Now imagine that same scenario with 60% less deliverable silver in the vaults. Fast forward to December 2020, and we saw the same pattern. During the final week of 2020, silver sat quietly around $26 per ounce, while retail investors coordinated what they called the silver squeeze movement. When markets reopened in early January 2021, the coordinated buying pressure hit a thin order book, and silver gapped from $26 to $30 in the first week. Again, COMEX registered inventories in 2020 were around 140 million ounces, nearly 3 times more deliverable silver than today. The silver squeeze created a price surge even with abundant physical supply. Have you noticed the pattern? Both previous Ghost Week surges happened when vaults were full and geopolitical conditions were relatively stable. We're now sitting in Ghost Week 2025 with depleted vaults, backwardation proving physical scarcity, and an active military confrontation escalating in real time. The historical precedents suggest silver moves violently during this holiday window. The current supply situation suggests any move will be amplified by scarcity. The geopolitical setup suggests the catalyst might already be in motion. Let me bring this back to Venezuela, because the escalation over the weekend has moved beyond rhetoric into operational reality. On December 21st, China's Ministry of Commerce announced that 2 Type 052D destroyers from their South Sea fleet were redirected toward the Atlantic Ocean for what they described as freedom of navigation operations. Russian Defense Ministry officials confirmed that 3 vessels from their northern fleet, including the Admiral Gorshkov frigate, were conducting routine patrols in the Caribbean Sea about 200 miles from where the USS George Washington Carrier Group is enforcing the Venezuelan blockade. According to ship tracking data from marine traffic and commercial satellite imagery, we now have American, Chinese, and Russian warships converging in the same body of water for the first time since the Cuban Missile Crisis. Naval commanders don't redirect destroyers from one hemisphere to another as routine operations. These are deliberate force projection moves, signaling that China and Russia aren't backing down from their access to Venezuelan oil. Think about Beijing's choice. They've spent 2 decades building energy relationships with Venezuela to reduce dependence on Middle Eastern oil flowing through U.S.-controlled choke points. Now we're interdicting their tankers and cutting off 700,000 barrels per day. According to the International Energy Agency, that represents about 6% of China's total oil imports, losing 6% of oil supply in an economy. China's size means rolling blackouts, factory shutdowns, and potential social instability. Beijing has to choose between accepting that supply cut, which signals America can strangle their energy imports at will, or responding with force to keep those supply lines open. There's no diplomatic middle ground. One side has to blink, and neither side has blinked yet. Russia faces a similar calculation with billions invested in Venezuelan infrastructure and their credibility as a superpower on the line. The market is starting to price this in, but slowly, because most institutional traders are on vacation. When those traders return to their desks on January 2nd, they'll review the news and make rapid portfolio adjustments. If they decide this confrontation could escalate, even a 5% allocation shift from bonds or equities into precious metals means tens of billions trying to enter a market with virtually no order book depth to absorb it. The result isn't gradual price adjustment. It's a gap, potentially a large one, and you'll either be positioned for it or explaining to yourself why you didn't see it coming when all the warning signs were flashing red. Now, let me show you the mathematical foundation that makes this gap scenario not just possible, but probable. On December 18th, the Federal Reserve cut interest rates to a range of 4.25 to 4.5% in what Chairman Powell described as a recalibration of monetary policy. That sounds reasonable and measured until you look at what's happening with inflation. According to the Bureau of Labor Statistics, the Consumer Price Index is running at 2.7% annually. Do the math with me here. If you're earning 4.5% on your treasury bonds, and inflation is eating away 2.7% of your purchasing power, your real return is roughly 1.8% before taxes. But here's where it gets interesting. That 2.7% CPI figure uses the government's preferred methodology, which conveniently excludes food and energy prices in core calculations, and uses hedonic adjustments that assume your smartphone getting better somehow compensates for your rent increasing. If you calculate inflation using the methodology the Bureau of Labor Statistics used in 1980, which economist John Williams tracks at ShadowStats, real inflation is running somewhere between 7 and 10% annually. That means the actual real interest rate, the rate that matters for your purchasing power, is somewhere between -2 and -5%. Think about what negative real rates mean for your investment portfolio. Every day you hold cash or bonds denominated in dollars, you're losing purchasing power. The Federal Reserve is essentially telling you through their policy actions that they will sacrifice the dollar's value to keep the economy from contracting. This isn't conspiracy theory. This is stated Fed policy going back to Ben Bernanke's famous helicopter money speech. And when central banks deliberately create negative real rates, they're forcing capital out of safe assets and into anything that holds value independent of currency debasement, That means real estate, commodities, and precious metals. Now here's the timing element that makes January 2nd and 3rd so critical. Institutional money managers who control pension funds, endowments, and sovereign wealth funds are required to rebalance portfolios at the start of each quarter. According to data from State Street Global Advisors, roughly $4 trillion in institutional assets undergo rebalancing in the first week of January. These aren't retail investors making emotional decisions. These are algorithms and mandates that automatically shift allocations based on risk parameters and expected returns. When those systems recalculate optimal portfolio allocation, with negative real rates as an input, the output is going to be increase hard asset exposure. And that recommendation hits simultaneously across thousands of institutions the moment markets reopen. But wait, there's a natural floor under silver that most investors don't know exists, and it's going to prevent any crash scenario, even if the Venezuela situation somehow de-escalates. Right now, silver is trading at $72 in New York, while the Shanghai Gold Exchange shows silver at $77 for immediate delivery. That $5 price difference is called an arbitrage spread, and it exists because Chinese buyers are willing to pay a premium to get physical metal into the country. According to the London Metal Exchange, this kind of persistent premium in the Shanghai market is extremely rare and indicates genuine supply shortage in the world's largest manufacturing economy. Here's why that $5 premium creates an unbreakable floor. If silver drops to $68 in New York, Chinese arbitrage traders will immediately buy COMEX futures, take physical delivery, and ship the metal to Shanghai, where they can sell it for $73, pocketing a $5 profit minus shipping and insurance costs that run about $1 per ounce. That arbitrage opportunity means that below $68, there's essentially unlimited buying pressure from traders making risk-free profits. The Shanghai premium isn't going away because Chinese manufacturers genuinely need silver for solar panels, electronics, and electric vehicle production. They'll keep bidding up physical metal as long as supply remains tight, which creates that floor that can't be breached without Shanghai prices crashing simultaneously. Now, let me explain the technical setup that makes this even more explosive. Silver just broke its all-time high of 72.71, which was set back in 1980 during the Hunt Brothers Silver Corner. When a market breaks an all-time high, something fascinating happens with algorithmic trading systems. Technical analysis programs that manage billions in commodity funds have breakout modules that automatically enter long positions when an asset moves into blue sky territory. Blue sky means there's no historical resistance above because the price has never been there before. According to Commodity Futures Trading Commission data, managed money accounts control roughly 40% of the silver futures market. And most of those accounts use some form of trend following or breakout strategy. What this means practically is that every cent silver moves above 72 or 71, it triggers additional buy orders from algorithms that are programmed to chase momentum. There's no resistance level at $75 or $78 or $80 because silver has never traded there in the modern era. The old high of 50 starred from 2011 is irrelevant because that wasn't even close to the all-time high. We're in completely uncharted territory, and the algorithms know it. This is the kind of setup that creates what traders call a meltup, where prices accelerate exponentially because the lack of sellers at higher levels means even modest buying pressure moves the market dramatically. Then there's the options market, which is primed for what's called a gamma squeeze. Call options at the $75 and $80 strike prices are currently very cheap because most traders assume silver won't get there quickly. But if silver gaps to $78 on January the 2nd, every call option below $78 goes deep in the money. And the dealers who sold those options are forced to buy physical silver futures to hedge their exposure. According to options data from the CME, there's significant open interest in call options between $75 and $85. If dealers have to hedge all of those contracts simultaneously, they'll be buying millions of ounces of paper silver in a market with virtually no depth. That forced buying from options hedging creates additional upward pressure, which brings more options into the money, which forces more hedging. It's a feedback loop that can move silver 10 or more in a single session once it starts. Let me give you the specific scenarios and targets, because this is where theory meets actionable intelligence. If the Venezuela situation escalates between now and January 2nd, specifically if China sends naval escorts to protect their tankers, or if there's any military confrontation in the Caribbean, expect silver to gap open somewhere between $78 and $82 when New York markets reopen. That gap will happen in the first 30 minutes of trading as Asia and Europe orders hit the COMEX simultaneously. You won't have time to react. You either have positions already or you're chasing at $80. If the situation de-escalates and diplomacy wins out, silver will likely consolidate in the $70 to $74 range during early January as traders take profits and wait for the next catalyst. But even in that scenario, the fundamental drivers remain intact. Negative real rates aren't going away. Shanghai premiums aren't going away. Depleted inventories aren't going to refill quickly. This means any consolidation is a setup for the next leg higher, probably breaking out in February, as institutional allocations continue flowing into hard assets. Here's the risk management piece that every investor needs to understand. The only scenario where silver crashes from here is if the $68 level breaks on high volume, meaning more than 100,000 contracts traded in a single day with price closing below 68. Given the Shanghai premium situation, that's almost mathematically impossible unless Chinese buying completely evaporates, which would require their economy to suddenly stop needing silver for industrial production. Your stop loss, if you choose to use one, should be below $68, not at $70 or $72, where normal volatility could shake you out of a winning position. The setup is binary. Either geopolitical risk escalates and we get a violent gap higher, or tensions ease and we get consolidation that sets up the next rally. Both scenarios are profitable if you're positioned in silver. The only losing scenario is standing on the sidelines watching, because you couldn't believe that Ghost Week, depleted vaults, negative real rates, and naval confrontations could actually align in the same 10-day window. But that's exactly where we are right now, and the market reopens in 8 days with all of these factors still in play. This isn't about predicting the future or gambling on binary outcomes. This is about understanding that when multiple structural factors align, markets move in ways that seem impossible until they happen. The professionals who manage billions recognized this setup in early December, which is why they pulled 47.6 million ounces out of COMEX vaults. They weren't worried about Ghost Week liquidity. They were worried about being on the wrong side of history when the gap happens.